The income method used within the income approach is divided into two types: the traditional income growth models, known as capitalization methods, including direct capitalization, term and reversion, and the discounted cash flow, DCF. The main feature of the discounted cash flow method is that anticipated growth in income and costs is explicitly incorporated into the model by the valuer. Discounted cash flow models are based on present value calculations of expected income or cash flow projected over a specific calculation period. Unlike the capitalization models, which imply a future sale but don't explicitly express its date, a reversionary value is normally calculated and discounted at the end of a notional hold period. Consequently, a time horizon, projected cash flow and reversionary value have to be determined. However, whichever model is used, valuers must be sure that it reflects the behavior of market participants. It is always better to use comparable evidence generated from market transactions whenever possible, with application of a pricing technique that is commonly used by market participants. To calculate present value, the estimated income or cash flow has to be discounted and a discount rate has to be determined. The conventional model for assessing the market value of commercial properties is direct capitalization or derivatives thereof, term and reversion or layer techniques, because it is grounded on comparison and the exclusive use of market data at the date of valuation. The explicit DCF model was used in the past for project feasibility analysis and estimation of investment value, and also today also widely applied. Growth implicit discounted cash flow is a more sophisticated method typically presented in the form of a 5 to 10 year cash flow and a terminal value, both discounted at a so-called equivalent yield, being the single discount rate which, when applied to all income flows, results in a present value equal to the capital value of the investment. It is in the internal rate of return that the cash flow changes are allowed for implicitly. The income flows reflect current, actual and market rents and costs. Capitalization methods are further broken down into two types. The perpetual models, where the market rent is, for the purpose of the implicit model, considered to be the same forever and all growth and future sales are captured in the yield, and the reversionary models, where in today's terms the rent passing is below or above the market rent that will be received at a future reversion to market rent. Capitalization is a market-based model which relies on strong evidence of market rents and market yields called capitalization rates. It relies on property market, both for investment and for lease, and requires sound analysis of property sales and property leases. If at the date of valuation, the rent paid differs from the market rent, then account must be taken of the actual rent and how long it will be paid until reversion to market rent, usually at the end of a lease and at rent review. In such a case, the value reflects projected changes in net income at certain defined future events, particularly at the end of a lease, rent review, or when major capital expenditure may be required. If you have found this video useful, please like, share and subscribe for more videos and write your comments or questions.